Welcome to The Money Manager. I'm Lindsay Williams in Cape Town. And in Johannesburg is Stephen Schultz, who's the Head of Marketing at Momentum Investments and Savings. Stephen, welcome to the show. I'm just reading this press release that came across my desk this morning, and it says something about the Momentum Growth Enhancer with lots of guarantees, limited downside, almost unlimited upside, and I really can't believe what I'm reading, so you're going to have to do a really good job to convince me. First of all, what sort of prompted you to develop a product such as this before we get into it?
Yeah, so I think the motivation for the product is largely based on where we find ourselves at the moment in terms of an economic backdrop. So maybe for a bit of context, some of the challenges which investors face today, I suppose not dissimilar. I read an interesting article this morning about the election campaigns which are taking place in the US at the moment. And I couldn't help but see the similarity between a US voter who obviously is pressed to make a decision now with no attractive presidential candidates coming forward. And I suppose you could classify investments in an investor's context pretty similarly, in that there's very few asset classes which are immediately attractive. So I suppose that environment or the challenges are a result of a few factors, but primarily there's been an ongoing theme of slower economic growth in a global context, and with that comes the prospect of more muted asset class returns. There's the ongoing suppression of commodity prices, and I think that if we're honest with ourselves, that is likely to persist for some time. The oversupply is not going to dissipate anytime soon. There's, as South Africans, we well know the ever-present risk of politics and what that can mean for investors. And then I think finally, if you look at corporate earnings in a global context, I think by and large we were disappointed over the past quarter. So if we look at the US, for example, I think there's perhaps a bit of a theory which may suggest that 7 years into the equity bull market, it may be getting long in the tooth and we may be due for a correction.
If I can just chip in here, Stephen, because what we had yesterday, or rather recently, we had a day when there were three pieces of economic data out, and I called it the Goldilocks day because one was warm, one was okay, just about right, and the other one was very cold indeed. The warm one was the Merchant Tech CEO Confidence Index, which showed that there was a plus 10% increase in confidence from CEOs, but still below 50, so therefore still mired beneath the cut-off point. Then we had PMI, which was just right, 3 months now above 50. It came down from 54.9 to 51.9, but still above 50. So that was good. That was just about right. And then the cold one was the dreadful NAAMSA figures, which showed that there was a 12.9% fall in passenger vehicle sales during the month of May on a year-on-year basis, and that is terrible. And that shows you that we are not confident, we don't have the money, the rand is under pressure, interest rates are rising. So I think what I'm trying to say here is that it's all very bitty, and that creates uncertainty, and I presume that's the background to the Momentum Growth Enhancer.
Absolutely. If I can just add to one of those, which is a little bit more philosophical, and that's the prospect of interest rates, not only in a South African context, but globally. So I think there's largely been, at least in my mind, some of the motivation behind asset price rallies, be it bonds, equities, etc., has largely been this lower for longer that we see play out in major central banks. And with that, we've seen more recently a divergence in monetary policy, whereby the US is hiking interest rates, and we see some very accommodative central banks outside of the US. And I think what we're slowly starting to find ourselves is in a situation where the impact of these measures is slowly being diluted. So we've seen in the case of Europe and Japan, they're testing those negatives, and certainly we're seeing a little bit less impact. And in the case of the US, the divergence is really breaking down in an admission by the Fed that they're not going to be hiking interest rates as quickly as they might have hoped last year. So I think that also casts a bit of a shadow on prospects for investors. And it's with each of these different negative components, or maybe a bit of a gloomy backdrop in mind, that we went about designing a product which we felt could cater for each one of those risks and still manage to deliver meaningful growth and deliver on clients' expectations.
Stephen, we need you're tempting me too much now. You're teasing me now. I need you to go straight into the product, because it says here this new innovative product is a game changer, you say rather modestly. Number one, how does it work? OK, your original investment amount is fully protected. So if someone gives you £1 million, no matter what happens, £1 million comes back. Over what period, though?
Absolutely. So it's a 5-year product, and it is a 100% capital guarantee, so your initial investment amount is protected, quite correct. But in addition to that 100% being protected, there's a guaranteed return of 25% over the 5-year term. So in fact, it's 125% of your initial investment is guaranteed.
OK, so first of all, you don't need to go into the details because it's obviously derivative-based, and very complicated financial engineering means that it's protected, but that's what you're doing. You take over all the risk there. It's guaranteed. It doesn't matter what happens. You get your £1 million back. I'm just using £1 million as an example. We'll get to how much you can put in later on. The second part, which you've already mentioned, you say here, you will receive a secured return of 25% irrespective of market performance. So what you're saying is, if over that 5-year period the all-share index goes down by 20%, or goes up only by 15%, or goes flat, no matter what the scenario is, 25% is guaranteed.
Absolutely, and maybe just to reiterate some of the risks in the market, I think that really talks to the peace of mind that we're planning on providing our clients. I think more often than not, the trade-off for a typical investor is whether to invest their money in some sort of an interest-bearing instrument, so perhaps a bank account, or alternatively the market. And we really see this as a bridging of those two worlds by saying you can participate in any market growth, but at the same time you don't miss out on the opportunity costs of a similar cash-type investment.
Well, it already sounds very good to me. But anyway, in addition, we enhance all index returns above 25% by 500%. So let's say that the instrument itself makes a 50% return over the 5 years. You get your 25% guaranteed. Now, tell me about the extra 25% and the 500% enhancer.
Yeah, so I suppose the other element that we were trying to address was a world of modest return. So I think depending on what journals you read, but pretty much across the board, the consensus seems to be that going forward we need to taper our expectations. And we need to come to terms with the fact that the market's not going to generate the generous returns that it previously did. So on that basis, we started thinking about ways of enhancing returns. So as you quite correctly mentioned, any returns above 25% at the end of 5 years will be multiplied by a factor of 5 or 500%.
Which is extraordinary. Then we go on to say, so what you're saying is here, almost you're getting your cake and you're able to eat it as well.
Quite correct. And one other very valuable characteristic of the product that we believe is we also took the task of identifying which markets are going to, or asset classes are going to outperform. And we have decided to overlay the structure on a multi-asset, globally diversified index. So effectively what that means is investors automatically get exposure to equity markets, global equity markets, global bond markets, global property markets, and finally commodity markets.
The minimum investment is £50,000. Have you launched it yet, Stephen?
Yes, so it launched last year. We're in a subscription period at present, which means investors can invest. The money's placed in an interest-bearing money market account, and the total investment amount will be traded later this month, at which time the investment will commence its 5-year investment term. OK, so it closes on a certain date. Is there a certain limit of how much you can trade? Because obviously with certain of the structures that you're using, certain of the instruments you're using, it can't get too big just in case that your claims go out the window, or rather you lose. I mean, is that the case? It can only get to a certain point? So it may well be a limited offer, and of course it's priced on various variables which change on a daily basis, which means we may not be able to provide the product well into the future, but there certainly isn't a maximum on the current offering. So although there is a minimum, no maximums.
What's been the reaction of the market? I mean, you must have gone to financial advisors and put out a marketing campaign. What has been the take-up? Are people suspicious of something that is guaranteed but gives you upside as well? Yeah,
so I think so perhaps the most harsh criticism we've had from the financial advisor community is, where does all this free money come from? I think it is realistic to say that to some extent there is a negative perception when we talk about structured products, and in light of what happened in the past, that's probably warranted. But the truth is, the real trade-off in this investment is not really the safety. It's a product provided by both Momentum and BNP Paribas, the French bank, which has a better credit rating than South African governments, in fact. But the real trade-off is, I think that an investor needs to come to terms with the fact that this is a 5-year investment. So we would strongly advise against clients who are looking to disinvest before the 5-year maturity. But provided an investor has a time horizon and is willing to stick it out for 5 years, the product really does deliver what it says on the tin.
Yeah, and it's typical suspicious financial advisors, isn't it? When they see this, Absolutely. They start to worry about, well, what structured products are you using? If you've got a contract saying you will get your money back and 25% plus an enhanced amount over any 25% that we can gain through our shrewd investing, then why worry about it? Is there any competition out there? Is there anything like this?
Yeah, so I think the number of structured products that are being marketed in South Africa is certainly increasing. There's a few big players in the industry, and slowly we're starting to see that appetite feed through into the financial advising, and I suppose financial advisors coming to terms with where structured products could potentially fit within a holistic financial planning proposition. So once again, maybe a caveat, we certainly wouldn't advocate investing 100% of a client's money in a product of this nature. But at the same time, we do believe it certainly is a useful tool to house a component of a client's investment.
Stephen, thanks very much for your time this evening. That's Stephen Schultz, who's the head of marketing at Momentum Investments and Savings, and we've been talking about the Momentum Growth Enhancer. And that's it for the Money Manager.